to my channel. Today we will be talking about Tesla. I will perform two videos. The first one will be just pure valuation, like I am used to do for the other companies. And the second video will be more like a business model, building a business model to give you like, okay, the estimation of the share price, let's say in the next 10 years. Be aware that all these information and the values that I will present to you are based on the current share price of $570. Okay, so the presentation will be split into 5 parts. I will first introduce you to the 3 main components of the earning results. So there are income statement, balance sheet, cash flow statement. From there I will extract the main, let's say, value data into what I call a DNA card. And basically it will give you all the tool and information to see whether they want to invest or not in the company. After that, I will just perform a value comparison with Ford, just to give you an example, and it will be very interesting to see actually the result on this one. And let's go. So I just want to make like a quick technical view here, just to identify what was the highs. It was almost like $1,000. And with the pandemic, I just went below, let's say, almost 400, and then now back to 650 today. Okay. So let's go into the income statement. Every time I present you these 3, let's say, statements, I take all the data from the last 4 quarters based on the last 10 Qs and summarize them into these tables. In this way, you can have at least a dynamic vision of the earnings, the results, gross margins. So first, if you look at the gross margin, because the revenue has been increasing, the gross margin has been increasing also from 12 to 19%, which is really, let's say, important. Sometimes the business have a very steady gross margin, but at least actually Tesla is still in this growing phase on the gross margins, which is really good. In addition of the gross margin, they also have had a revenue increase from almost sequential revenue increase from Q1 to Q4. Just be aware that this revenue increase, let's say on Q1 usually is the first quarter that is like quite, how to say, the smooth quarter, like a low number quarter, so don't expect to have like a sequential growth from Q4 this year to Q1 2020. Also on the OPEX split, as you can see, the cost of products is the major part spent from the revenue. But as you can see, over the last 2 quarters, for the first time, Tesla has been a profitable company. So it's like the net income, they get a positive net income. They also maintain quite a high research and development ratio, at least 5%. It's not high, but at least it's decent for a car company. And basically, yeah, they invest a lot into this new technology, so it's quite normal to have such a ratio. Now let's switch to the balance sheet. The first point I like to do, so the same here, it's dynamic vision. So on each item you can see like Q1, Q2, Q3, and Q4 values, and it gives you an idea of what is the direction of each of the items. The first point I don't like to see on a balance sheet is the long-term liabilities, which is almost $17 billion. And what I like is more the cash and equivalent increase, let's say from $2 billion to $6.3 billion. Also, what is not mentioned in this Q4 2019 is that they agreed on an extra $2 billion, let's say, funding, which bring the cash up to $8 billion. Now, if I look at the total current assets, we will have around $12 billion. And if you subtract, let's say, the $10 billion of current liability, this is how you calculate your working capital, which is not more than $1 billion. So overall, let's say the balance sheet is not so strong. It has a lot of long-term debt, a little bit of cash, and just a positive working capital, but not crazy. Let's switch to the cash flow statement. So here I summarized the last 4 years of operation and added into the table the 3 main components of this cash flow statement, which are financing part, investing part, and operating parts. As you can see, on 2016 and 2017, they have been going through a lot of financing. almost $7 billion into financing via, so as you can see here on the table, issuance of stock and also issuance of debt. Over the last 2 years, the company has stopped financing that much, at least much less than the years before, and has at least developed its operating cash flow, so via the elements of non-cash item and depreciation, depletion. Also, as you can see here, the yellow part is only capex related. So basically, they burn, let's say, this year, a billion, 1.5 billion, and expect to burn for the next 2 years between $5 and $6 billion, if I'm correct, to build the next gigafactories. Here also, I like to look at the number of shares outstanding, and in cumulative from 2016 to today, the share numbers increased by 12%. So it's not let's say that good, but for a growing company, it needs to fund some money via VC stock dilution. So what I like to look now on the DNA card is to be able to develop what is the yield return of the company. The way I'm doing this is basically the first step is to calculate the enterprise value. Enterprise value is basically calculated from the market capitalization, where you remove the working capital because it's like more or less cash available in hand that is not useful for the valuation, but you add also the long-term debt on top of the market capitalization. Why do you do that? Because a company could have a big debt but not be represented into the market cap. That's why the enterprise value at least gives you like a more fair value of the enterprise, and that's the value that you reach for Tesla today with a share price of 570 of $118 billion. Now the free cash flow, the way I'm doing it is simple. I just take the earning and then I subtract the depreciation. So even let's say, so here I get the final free cash flow for the year, which when I divide it by the enterprise value gives me a yield return, like a return of the company, which is negative. So this is not such a good point. Even if I take the last quarter and multiply by 4, so to get like an idea of how it's going to be for the next quarters, the company is still not profitable. The last part I'm doing is also if I remove all the R&D expenses, basically if the company stops investing in research and development, I'd like to see how much yield it returns. And again, I have a negative value of minus 0.3%. So let's move to the next part, which is the valuations. The price to sales and EV to sales actually are between 4 and 5, which for a company that has a gross margin of 19% is a little bit high. Usually you should expect a price to sale or EV to sales around 2. Just on the valuation side, I don't speak about, let's say, any anticipation for revenue growth. Also, the price to cash is super high. Usually you want it to be at least less than 10, meaning that the company doesn't have too much liquidity at the moment. And for me also this is a minus, a negative point. Now let's look at the operating leverage characteristics. So what I summarized here is the revenue growth over the last 3 years on each of them, and also the OPEX growth for each year. And then when I sum them up, I get like the revenue growth over the last 3 years, which is 250%, which is amazing. But what is even more amazing is the OPEX growth has been only 76%. So what you can see here is basically that any revenue growth is not necessarily the result of more spending into the OPEX. And that is exactly what you want to see in a company, is this operating leverage. So as you can see here on the DNA card, if I summarize, the yield return at the moment is, let's say, quite absent. The value metrics compared to the, let's say, the profile of the company is a little bit high, maybe 2 times, 3 times higher than what it is expected to be. But the operating leverage is huge, is amazing. Now let's go to the comparison with Ford, and that's going to be a very interesting one. Here I did exactly the same DNA card, so I copied the DNA card from Tesla that you saw like just on the previous slide, and I did the same exercise, same homework for company Ford. And basically what I'm trying to do is basically extract from each of the most important values, compare them face to face, and give them like 1 point if one of the company is beating the other one. And so my let's say criteria are: first, free cash flow by enterprise value. Tesla, much better. The revenue growth over the last 3 years, Tesla, much better. The net margin, also Tesla, slightly better than Ford. The operating leverage, so this is basically the revenue growth minus the OPEX growth, is actually much better on Tesla than Ford. Ford doesn't have any revenue growth, and like the OPEX growth was also constant. So basically Ford is not growing at all. Also, the operating revenue per employee can be also a very good indication of the efficiency of the company. For Tesla, it's a little bit better than Ford. Long-term debt divided by earning, I don't consider them here because actually the values are like negative, so the calculation is not working. But basically, I like to look at the long-term debt divided by capital market cap, and as you can see, Tesla has only 13% compared to 600% of debt compared to market cap for Ford, which is just like over the top. Then after I look at the retained earning divided by the market cap, in this case Ford has been like profitable over like the past decade, so it's a plus for him. And also the cash per employee, Ford is a little bit better than Tesla. So overall, if I count all these points for Tesla and Ford, I end up with the winner being Tesla by far. So here's my conclusion. Here is my conclusion. The pros for the company. First, that you know that Tesla benefits from a big moat on the technological side. Especially on the EV, they are very advanced in terms of battery, cost of product. So with the Gigafactory that improve every time, let's say every time. Also on the safety of the cars, and especially also on the software. When it's electrical car, you want to have a strong software. So the point of competition, the balance sheet is much better than for overloaded by debt. Let's say in the solar in terms of back well and technology also on 3,000 also it might hold and it years actually it's also premature is with the reason why so some basically the like but if you very and just and then